Spotify was supposed to be the company that saved music. A 28-year-old Swede built the thing that pulled an entire industry back from the edge of piracy and collapse. Wall Street believed it. At its peak, the valuation hit $100 billion. Analysts were calling it the Netflix of audio. Then in 2022, the stock lost 70% in a single year. In 2023, the company cut 27% of its workforce in 3 separate rounds. A $1 billion podcasting bet turned into a $500 million write-down. And the man who saved music became the man artists most resented. So how did a platform with 600 million users bleed money for over a decade? And what was the one decision that changed everything? Let's go all the way back, because this story starts in a teenage bedroom in Stockholm and ends with a billion-dollar reckoning nobody saw coming. Daniel Ek grew up in Rugsved, a working-class suburb of Stockholm, Sweden. He taught himself to code at 8 years old. By 14, he was building websites for local businesses and charging real money for them. By 16, he was running a small web design agency with employees. He was a teenager with a staff. He enrolled at the Royal Institute of Technology in Stockholm to study engineering. He dropped out after 8 weeks, not because he was failing, because he was bored. The classroom wasn't moving fast enough for what was in his head. He spent the early 2000s in the Swedish tech scene, running a company called Advertigo, which was eventually acquired by Tradedoubler, making Ek enough money to retire at 23. He tried retiring. He spent several months playing video games in his apartment and discovered that having nothing to do was, in his words, the worst experience of his life. In 2006, he co-founded Spotify with Martin Lorentzen, the co-founder of Tradedoubler. The problem they were trying to solve was specific and urgent. The music industry was collapsing, not declining, collapsing. Global recorded music revenue had fallen from $25 billion in 1999 to under $15 billion by 2006. The culprit was piracy. Napster had launched in 1999 and taught an entire generation that music was free. When Napster was shut down, LimeWire filled the gap. When LimeWire was shut down, BitTorrent took over. The labels won every legal battle and lost the cultural war completely. iTunes had launched in 2003 and offered a legal alternative, 99 cents per song. It helped. So it wasn't enough. People had already learned that music was free, and charging them $1 per song while piracy was literally one browser tab away was a losing proposition. Ek looked at this and saw not a crisis, but a design problem. The pirates weren't stealing because they were criminals. They were stealing because the legal option was worse. Inconvenient, expensive, fragmented. If you could build a legal service that was faster than piracy, more convenient than piracy, with better catalog than piracy, you could beat piracy. Not with lawsuits, with a better product. The insight sounds obvious now. In 2006, it was genuinely radical. The music industry's answer to piracy was litigation. Ek's answer was design. Getting the labels to agree was the hardest thing Spotify ever did. Harder than the technology. Harder than the business model. Harder than eventually going public on the New York Stock Exchange. Universal Music Group, Sony Music Entertainment, Warner Music Group, and EMI collectively controlled the rights to the vast majority of commercial music ever recorded. Without their catalogs, Spotify was a streaming service with nothing to stream, and the labels had every reason to say no. They had already lost billions to piracy. They had watched iTunes take 30% of their digital revenue. They were not enthusiastic about licensing their catalogs to another tech company at terms the tech company was proposing. Ek spent 2 years, 2006 and 2007, in rooms with label executives, convincing them that the alternative to Spotify was not the status quo. The alternative was continued piracy. Spotify wasn't taking money from the labels. It was recovering money that was already gone. It worked. Not immediately, not completely, but enough. By 2008, Spotify had licensing deals with the major labels and launched in Europe with a catalog of approximately 6 million songs. The free tier was supported by ads. The premium tier cost the equivalent of $9.99 per month with no ads and offline listening. The reaction was immediate. In markets where Spotify launched, music piracy dropped. Not a little. Measurably, significantly, verifiably dropped. The product was better than piracy. Ek had been right. The waitlist for Spotify invitations in the UK became a cultural phenomenon. People were trading invite codes the way a previous generation had traded mixtapes. The platform that had been born in a Stockholm apartment was becoming something the music industry had declared impossible. It was saving music. The United States was a different story. The American music market was the largest in the world, and the American labels were significantly more resistant than their European counterparts. Spotify spent 3 years negotiating US licensing deals before finally launching in America in July 2011. 3 years of watching their European success grow, knowing they couldn't replicate it in the biggest market on earth because the gatekeepers wouldn't open the gate. When they finally launched in the US, the reception was extraordinary. Within 6 months, Spotify had 10 million users in America. By 2012, it was growing faster than any streaming service in history. The media coverage was rapturous. Time magazine, Wired, the New York Times. Everyone was writing the same version of the same story. This is the company that finally figured out music, and Daniel Ek was its prophet. He appeared on magazine covers. He gave keynote speeches about the future of creativity. He used a phrase that would follow him for the rest of his career. He said Spotify was the best thing that ever happened to music. He believed it. He may have been right at the time, but he had made a deal to get here. And the terms of that deal were already embedding a contradiction at the center of Spotify's business model that would take over a decade to fully detonate. Here is the deal Spotify made with the labels, and here is why it mattered. To license the major label catalogs, Spotify agreed to pay out approximately 70% of all its revenue back to rights holders, labels, publishers, and artists in the form of royalties. 70%. That means for every dollar Spotify earns from subscriptions, from advertising, from anything, 70 cents goes back to the music industry before Spotify can pay a single employee, a single server bill, or a single line of infrastructure cost. For comparison, Netflix keeps approximately 65% of its revenue after content costs. Apple keeps 70% of App Store revenue and pays 30% to developers. Amazon Web Services operates at margins above 30%. Spotify, from the moment it launched, was structurally designed to be almost impossible to make profitable. The 70% royalty floor wasn't a temporary concession to get the labels on board. It was baked into the licensing agreements. It was the price of the catalog, and without the catalog, Spotify was nothing. Daniel Ek knew this. He knew it when he signed the deals. His calculation was that scale would solve the problem. If Spotify could grow large enough, 100 million users, 200 million, 500 million, the sheer volume of subscription revenue would eventually produce a meaningful margin on the remaining 30%. It was a growth at all costs strategy. Acquire users, suppress prices to maximize adoption, worry about the margins later. This was the Silicon Valley playbook applied to an industry that had never experienced it before. The artists, watching from the outside, saw something different. They saw a platform that was paying fractions of a cent per stream, and they started doing their own math. The numbers that emerged were staggering in their smallness. Spotify paid and still pays between 3 cents and 5 cents per stream. That's between 0.3 of a cent and half a cent. To earn the U.S. federal minimum wage of $7.25 per hour from Spotify streams, an artist would need approximately 1,450 to 2,400 streams per hour. Every hour to earn a single minimum wage. To earn $1,000 in a month from Spotify, roughly the minimum viable income in most American cities, an artist would need between 200,000 and 330,000 streams in that month. Not total, monthly. Most artists, the middle tier, the ones with genuine local fan bases and real audiences, the ones who used to sell CDs and digital downloads and make a modest living from music, were generating thousands of streams per month, not hundreds of thousands, thousands. Their monthly Spotify checks were $3, $12, $47. Taylor Swift looked at these numbers in November 2014 and pulled her entire catalog from Spotify. She wrote an op-ed in the Wall Street Journal explaining her reasoning. She said that music is art, and art is rare. And rare things should not be free. She said Spotify's free tier, where listeners could access all music with ads at no cost, was devaluing music at a fundamental level. She was the biggest artist on earth at that moment. Her album 1989 had just sold 1.287 million copies in its first week, the largest first-week sales since 2002. She didn't need Spotify, and her exit made headlines in a way that no academic paper about per-stream royalty rates ever could. The conversation had changed. Spotify was no longer just the company that saved music. It was becoming the company that artists resented. Daniel Ek's response to the artist criticism was consistent and confident, and, in retrospect, deeply revealing of his fundamental misunderstanding of the creative community he was serving. He argued that Spotify was better for artists than the alternative. He pointed to the billions in total royalties paid out. $1 billion by 2013, $3 billion by 2016, $7 billion by 2018. He said the per-stream rate was misleading because what mattered was total revenue flowing into the music ecosystem. He said critics were comparing Spotify to a world that no longer existed, a world of album sales and physical distribution, rather than comparing it to the real alternative, which was piracy and zero revenue. Music. These arguments had merit. They were also profoundly tone-deaf to what artists were actually experiencing. An artist who had sold 50,000 albums in 2005 and earned $500,000 from those sales was now generating 2 million streams per year and earning $7,000. The math of Spotify's aggregate royalty payments didn't matter to that artist. What mattered was that their personal income had collapsed by 98.6% in a decade. In 2021, Eck made the statement that would define the public perception of his relationship with artists forever. In an interview, when asked about musicians struggling to make money on the platform, he said, "I feel, really, that the issue is that some artists that used to do well in the past may not do well in this future landscape, where you can't record music once every 3 to 4 years and think that's going to be enough." He was saying that artists needed to produce more content more frequently to succeed on Spotify. The reaction from the music community was immediate and volcanic. Artists, producers, managers, and industry observers interpreted the statement as Eck telling them to work harder for the same fraction of a cent rate, to be more like content farms and less like artists. Billie Eilish's manager condemned the statement. Industry veterans called it insulting, and the resentment that had been building for years calcified into something permanent. But here's the thing that almost nobody was discussing while the artist royalty debate was consuming the headlines. Spotify had a much bigger problem, a structural problem, a problem that had nothing to do with Taylor Swift or per-stream rates. Spotify was losing money. Consistently, massively, structurally. In 2015, Spotify lost $230 million. In 2016, it lost $539 million. In 2017, it lost $1.5 billion. In 2018, the year it went public on the New York Stock Exchange, it lost $1.24 billion. In 2019, it lost $186 million. In 2020, it lost $581 million. Spotify had been losing money every single year since its founding. For over a decade of operation, as a public company with hundreds of millions of users and billions in revenue, it had never turned an annual profit. The 70% royalty floor was functioning exactly as the math suggested it would. Scale had arrived, hundreds of millions of users, but the margin hadn't followed, because every new subscriber added revenue, and 70% of that revenue immediately flowed out to the labels before Spotify could do anything with it. The growth strategy was working. The profit strategy didn't exist. Nay, Wall Street had tolerated this because Wall Street had decided Spotify was a growth stock, not a value stock. A growth stock. That's a company investors value based on future potential rather than current earnings. Investors were buying the story of where Spotify was going, not where it currently was. And the story was compelling. 600 million users, the dominant platform in streaming, a brand synonymous with music itself. As long as interest rates were near zero and capital was cheap and patient, the growth story held. Then interest rates rose, and Wall Street stopped being patient. January 2022, the one decision, the moment that restructured everything. Neil Young, the Canadian rock legend, the author of Harvest Moon and Heart of Gold and Rockin' in the Free World, sent a letter to his management team that he later posted publicly. In it, he demanded that Spotify remove his music from the platform. His reason was not royalty rates. His reason was Joe Rogan. The Joe Rogan Experience had become the most listened to podcast in the world. Spotify had acquired exclusive rights to the show in May 2020 for a reported $100 million, later reported to have been closer to $200 million when full deal terms were considered. It was the largest podcast deal in history, and it was the centerpiece of Spotify's strategy to escape the 70% royalty trap. Here was the logic. Yeah, and if Spotify could become the dominant platform in podcasting, a medium where Spotify owned the content rather than licensed it, it could build a business segment with normal margin, 50% margin, 60%. The economics of owned content versus licensed music were incomparably better. Rogan was the anchor, 11 million listeners per episode, the most downloaded podcast on Apple Podcasts for years. If Spotify could take him exclusive, they would force his audience onto the Spotify platform and accelerate premium subscription conversion. It was rational. It was strategically coherent. It was the right idea in theory, and it created a crisis that wiped billions from the company's market capitalization in 2 weeks. Han Young objected to specific episodes of the Joe Rogan Experience, in which Rogan had platformized guests who spread what Young characterized as COVID-19 misinformation. Young said Spotify could have Rogan or it could have Neil Young, not both. Spotify chose Rogan. Within 24 hours, Young's music, over 60 years of catalog, was removed from the platform. Then Joni Mitchell followed. Then Niels Lofgren. Then India Arie, who published a video compilation of Rogan using racial slurs, escalating the crisis from a health misinformation debate into something significantly more combustible. The hashtag delete Spotify trended globally. Spotify's stock dropped approximately 12% in the week following Young's departure. The company lost over $2 billion in market capitalization. Eck issued a statement. He said Spotify did not endorse Rogan's views. He said he personally found some of the content very offensive. He said Spotify would add content advisories to podcast episodes discussing COVID-19. He declined to remove Rogan from the platform. For many observers, the statement read as confirmation of Young's original accusation. Spotify knew the content was problematic. It just valued the 11 million listeners more than it valued its relationship with the artists whose music built the platform. The Rogan deal had seemed like the solution to Spotify's structural profitability problem. In the 2 years that followed the Neil Young crisis, it became a symbol of everything that had gone wrong with the podcasting strategy. Spotify had not simply signed Joe Rogan. Between 2019 and 2022, it had spent approximately $1 billion on podcast acquisitions and exclusive deals. It acquired Gimlet Media for $230 million. It acquired The Ringer, Bill Simmons' sports and culture media company, for $196 million. It acquired Parcast. It acquired Anchor, the podcast creation platform. It signed exclusive deals with Obama's production company, with Kim Kardashian, with Meghan Markle's Archewell Audio. The podcasting empire Spotify was building was vast and expensive, and it turned out largely unprofitable. In June 2023, Spotify announced it was shutting down Gimlet Media and Parcast as standalone studios. The original programming they had produced, award-winning podcasts like Reply All and Crime Town, would be wound down or transferred. The $230 million acquisition was being written off after 4 years. In September 2023, it was reported that Spotify had written down the value of its podcast investments by approximately $500 million. $500 million in value gone. The bet on owned podcast content as the escape route from music industry royalties had not produced the margins that justified the investment. The Ringer survived. Rogan's contract eventually expired, and he signed a new, non-exclusive deal, allowing his show to distribute on other platforms. The exclusivity that had cost $200 million and triggered a global PR crisis and a 12% stock drop in a single week. The exclusivity was gone. The layoffs came in 3 waves in 2023, and each one was worse than the previous. January 2023. Spotify announced it was cutting approximately 6% of its global workforce, around 600 employees. X cited the economic environment and the need to manage costs more aggressively. June 2023, a second round of cuts. This time, the podcast division bore the brunt. Hundreds more employees gone, along with the formal announcement that Spotify was pulling back from its original podcast content strategy. The studios it had acquired were being restructured or dissolved. December 2023, a third round, 1,500 additional employees. This time, X's letter to employees contained a line that summarized the entire arc of the company's decade-long struggle. He said Spotify had been too ambitious in its investments during the period of easy money and low interest rates. 3 rounds, 27% of the total workforce in a single calendar year, from a company with 600 million users, from a platform processing billions in revenue, seen from the company that saved music. The cognitive dissonance was staggering. How do you have 600 million users and lay off 27% of your staff in 1 year? The answer is the 70% royalty floor. It was always the answer. The users were there. The revenue was there. The money was not. Here's where Spotify stands today, and the picture is complicated. In 2023, for the first time in company history, Spotify turned a quarterly profit. Not annual, quarterly, but actual positive operating income. The layoffs had compressed the cost structure enough that the 30% of revenue Spotify retained was finally, barely, exceeding operating expenses. The stock recovered from its 2022 low. By late 2024, it was trading above $400 per share, higher than its previous all-time high. The market rewarded the cost-cutting with enthusiasm that might strike the 2,700 employees who lost their jobs as ironic. But the structural problem has not been solved. It has been deferred. The 70% royalty rate still exists. The labels still control the catalog. The artists still earn fractions of a cent per stream. The math that made Spotify unprofitable for 15 years hasn't changed. Spotify just cut enough operating costs to produce thin margins on the 30% it keeps. And the artist community has not forgiven the platform for the decade of sub-minimum wage payment, or for the Rogan decision, or for X comment about producing more content. The resentment runs deep, and it is structurally justified.